Most people think the only way to pay off a mortgage is by making double payments. But what if there's a smarter way to do it without spending so much more each month? I've helped dozens of families crush their home loans in under 10 years without increasing monthly payments. So in this video, I'm going to show you how to restructure your payoff plan so your money works harder, not just faster. And stick around because I'll share the #1 mistake that keeps people stuck in 30-year loans even when they could be debt-free sooner. Let's dive in. So here's the #1 mortgage myth most people still believe. A 30-year mortgage with low payments is best, when the truth is it's actually best for your bank and not you. So we have $400,000 at 6%, $2,398 per month. Now, you and I both know that $2,398 is not going directly to the principal. It is getting divided up. And this is how it's getting divided up in the first month. $2,000 goes where? To interest, as we've said, and then $398 is going towards the principal. But CJ, it's going to get better as you continue to pay along. That's very true. It does get better, but only by a little bit, right? 180 months, that's going to equal 15 years. At the halfway mark of your mortgage, of your death pledge, you're at $1,425 still going to the bank and $973 going towards the principal. So it does get better. You're right. But is there a way that we can allocate our finances to where this loan is knocked out in 10 years or less rather than 20, rather than even the 15 or rather than the 30 years? I do believe it is possible. Let's go ahead and go over here to the Velocity Banking way, and we're going to look at the first month. Now, of course, the first month, it is $2,000 still towards interest. Why is that? Well, because the bank has to get their money in the first month. However, we've allocated $1,000. Now, what is that extra $1,000 going to do? Well, first of all, that $1,000 is going to make sure that the principal is knocked down, because remember, when you're talking about loans, it's always going to be about knocking that principal down. We've got to get out of the mindset of always looking at that interest rate. A lot of people do that. Let's go into the time and balance aspect of this loan so that we can knock it down quantitatively, right? So we can knock it down astronomically. So let's go to the 12th month, 1 year. $1,921 goes towards the interest, while $1,477 goes towards the principal. What is that doing? It's knocking the principal down even more. So that in the second year, how much are we giving to the bank? Even less proportionally than we were the last year, $1,830, while we're getting more to the principal. And in the third year, we have $1,733 to the bank. That is drastically lower than if we were to pay traditionally. Now, if we look at this and calculate the total interest of this loan, the total interest would actually be $463,000. Folks, that's just the interest. So really, you paid more than the house by over 2 times. Is that something that you would like to do? Go ahead and comment down there. You don't mind that astronomical payment. What is it? If I could just ask you this, what is the biggest thing stopping you from paying your mortgage off faster? What's the biggest thing stopping you? Go ahead and comment down below. I want to see that. What's the biggest thing stopping you? Is it a student loan? Is it a car loan? All right. Because when you're paying your mortgage like this, you've got that $1,000 surplus. The cash flow is there. You're not going to want to put that into something that will only make you $120 a year, like say a savings account would, right? Remember how we were taught. We were taught to place and to segregate our income, meaning let's go ahead, get the paycheck, and then we're going to divide it up into a checking, a savings account, our lifestyle. Oh, we got groceries. Oh, we got the mortgage. Oh, we got a credit card. Oh, we got a car loan. Oh, and we're segregating our income instead of utilizing how the wealthy do, and that is utilizing lines of credit where not only, right, our $1,000 is making more, right? Because if you only had a 1% yield on that $1,000 you were given to your savings account, right, every month, you would only make $120 a year versus paying off each and every month $1,000 towards the mortgage principal. You would actually be saving $336 each and every year. And oh, by the way, that actually goes up. Okay, now we want to take a look at that, and then we want to decide, well, should I stay in the traditional banking mode, or should I use my line of credit as my new checking account? All right. And this isn't the only way you can pay off this mortgage, right? You can also have a line of credit. Okay. Remember, we have a line of credit now, $10,000. Okay. Let's say that line of credit was at $10,000. Maybe yours is more. You take that $10,000 and deploy it towards this principal. What is that going to do? Well, it's going to knock down how much interest you owe, because the bigger the principal, the bigger the interest. And not only that, since you already have a surplus of $1,000 each month, you're going to be paying the line of credit. So you're using that line of credit as your new checking account, because all of your income is going into the line of credit. You're paying your expenses from your line of credit, and at least $1,000 is staying in there each and every month. That $1,000 is doing what? Working for you instead of against you. That's what it's doing. And so this is going to be done in about 10 months, right? 10,000 divided by that extra cash flow, right? 10 months. What are you going to do at the end of that 10 months with this cash flow of $10,000? You're going to deploy it again and again and again. So it's basically wash, rinse, and repeat. And that's how it's done. Now I want to show you something that you might be blown away by. Let's say you don't do the $1,000 extra a month, and let's say you don't want to deploy from the line of credit. If you just one time added to the first month payment, and it was strictly going to principal. Okay, so $898 is going towards the principal. Do you know that $500 would yield you more than your IRA for that month? Watch this. Because you would save, if you wanted to continue to go by the bank's plan, with this $500 extra payment, did you know that you would save over $2,493 in interest? $2,493. So in the mortgage, in this particular mortgage, in this particular scenario, $500 equals $2,493 in your pocket, not the bank's. So 3 main tools you'll want to keep in mind as you're paying off your mortgage. And quite frankly, man, let's go ahead and keep these in mind, at least 2 in mind, when you're paying off any gargantuan loan. First of all, we have the sweep account. What does that do? Well, it actually offsets the balance so that those interest rates, those interest dollars, are lower, all right? Same thing that goes when you're talking about a HELOC. HELOCs actually attack amortized debt. All right. And personal line of credit, well, it's basically the same thing, but that's if you don't have any real estate. You got a personal line of credit. You take out the $5,000, you take out the $6,000, and you put it towards the principal of any loan to reduce how much you're paying the bank. Now, when we're talking about sweep accounts, not every bank does this, but it is an account that is tied to that mortgage. So it's actually tied to the mortgage. All right. So what does that mean? That means if your mortgage is $400,000, right? It's no longer just that $400,000 when you start to pay and you sweep that account. All right. If you have any questions about that, please let me know. All right. And we have so much information that you could be getting on the free webinar that we have every Tuesday. Go ahead and click on the link below if you have questions about that too. And this is just some of the mistakes that people make that actually keeps them stuck. It's all about the focus, all right? Their priority is on the rate and not the structure of the loan. The structure is going to be more important than the rate, folks. I'm going to tell you, we have to take advantage of time and balance because the banks are taking advantage of time and balance when it comes to our finances. It's time to switch that around, all right? And another mistake I see is they're saving while carrying that high interest debt. They're still doing that. They think that saving that $120 a year, remember in our prior discussion, is better than cutting off $336 a year in interest when that's not the case, all right? Income expenses, they don't know. There's some people don't know their income and their expenses, which I'm actually glad to say that our Money Max account takes care of strategically. I mean, strategically and tactically, it lets you know the income expenses that of course you put in, and it shares with you how you're going to pay off the mortgage in 5 to 7 years instead of 30, and of course more loans as well. Extra random versus strategically. So people believe in paying extra amounts, but they don't know how to pay it. They're just giving it to the bank, and the bank's like, thanks for the extra. We'll go ahead and put some here in the interest for us and some in the principal. No, all those extra payments need to go straight towards the principal. And last but definitely not least, what happens in 5 to 7 years usually? People either move or they do what? Refinance. And some of them think that refinancing is the only path when that is not the only path. You can actually get cash flow calculators, you can do spreadsheets, or you can get the Money Max account, which we offer. You could just do a whole lot of things that can clear the path for your success, not only now, but also in the future. If this got you thinking, check out my next video where we break down the exact cash flow strategy that clients use to pay off not only their homes, but their car loans as well. And also we have a free webinar that you can go to right here in the description link below. Let me know if you want more of these, and we will talk to you on the next video.